Number 3, defense. Because if the war goes on longer, well, that means more money is going to be going into building ammunition, building tanks, building jets, building other military equipment. And those companies are private, meaning they're owned by investors. And you can own a piece of those companies on the stock market, and you can invest in funds that will give you exposure to those military-related companies. Again, my job here is not to tell you what you need to believe in or what your morals need to be. Because yes, there are certain things that I will not invest in because I just don't believe in it, but I'm here to tell you how Wall Street thinks. That way you can understand how to think like an investor. ITA is an ETF that's going to give you exposure to the defense industry. And as wars go on longer, government contracts get bigger for these defense industries. Number 4 is United States industrials. If tariffs are intended to bring manufacturing and businesses back to the United States, and that actually works, well then those companies that are bringing these industrials and manufacturing here could see benefits because then they can avoid the tariffs, they can avoid the supply chain mess, and they can continue to build more manufacturing here in the United States. So you can invest in those industrials, and an ETF like XLI can give you exposure to United States industrials and reshoring of companies here into the United States. And then number 5 on the more defensive side that can also pay with income is RE, meaning real estate. This is not an ETF, it's an acronym for investing in physical real estate, because no matter what happens with artificial intelligence, people are going to need a place to live, people will need places to go and eat. You can own the real estate and generate income from it. Or an ETF like SCHD. As a disclaimer, I'm personally invested in SCHD. This is an ETF that will give you exposure to high dividend paying companies in the United States. It's not a way to invest in huge growth, but it's a way to create stable income, because these are companies that have been making big profits, that are working to grow their businesses, but also working to grow how much income they're paying. So SCHD is one of those dividend plays. The way that you win with these types of things is through a strategy I call ABB, always be buying. And the way that works is you buy every week, every 2 weeks, every month, whether markets are going up and down. The only time you change it is when markets go down. Maybe you buy a little bit more because it allows you to buy more at a discounted price. So what we talked about in this video is that our economy is changing. We know that this war in the Middle East is going to change inflation, it's going to change oil prices. We don't know how long it's going to take, but the reason why it matters is because if you start to study what things like Ray Dalio says, Ray Dalio has been talking about this long-term debt cycle. And there are 5 stages, 5 key pieces to a long-term debt cycle.